These people had one thing in common. They knew they had it in themselves. They knew they could be something beyond where they were.
Market crashes are painful, but they can also bring huge opportunities. Moves made in a bear market will often have an outsized impact on your overall returns, and many of history's most successful investors built their fortunes and cemented lasting legacies by capitalizing on volatility and uncertainty. But how? Let's find out. Nobody knows when a stock or a stock market has hit bottom. People can speculate, and every analyst hoping for a little bit of television fame will most certainly will, but no person, no matter how many past predictions they claim to have gotten right, know when a stock or market has fallen as low as it will go. And while it's tempting for an investor to wait for better prices, that's a dangerous game to play. Yes, you might get a better price by waiting, but you also may find yourself waiting too long and missing an opportunity. Down markets, bear markets, market crashes, whatever you want to call them, follow no rules. A market correction takes overhyped companies that have underdelivered down in value while also dragging down shares of strong companies which have performed well. As a long-term investor, your job, or at least the best path to accumulating wealth, isn't figuring out where the bottom is. Instead, it's sorting out the companies that have a bright long-term future, where today's price will hardly matter, from companies that saw their share prices drop because they don't have sound business fundamentals. Investing in a crisis is no doubt risky, for the timeline and scope of recovery are uncertain at best. Double-dip recessions are a real possibility, and attempting to pick a bottom is largely a matter of luck. Still, those investors who can invest in a crisis without succumbing to irrational fear and anxiety may reap outsized returns during recovery. What is a long-term investor? Long-term investors consider down markets as an opportunity to add to their portfolios. Before you can think about doing that, you have to think about what it means to be a long-term investor. A long-term investor buys shares in companies they intend to hold for years, essentially forever. Usually, a long-term investor has an investing thesis as a reason why they want to own the stock. That thesis should give the long-term investor faith in that stock even when the company's share price drops. A long-term investor checks in on their holdings to make sure the company has not made a change that causes it to diverge from that thesis. For example, did the CEO change and the new leader made a major change to how the company operates? Or did something huge happen in the market that causes you to change how you see the company's prospects? Long-term investors understand that many companies, Amazon being the most famous example, don't manage to deliver quarterly results. Instead, their leaders make the best decisions for the company to succeed over decades, not quarters. That's why they have been willing to have money-losing quarters, where it invests in infrastructure it needs for long-term success. What sectors fare well even during recessions? Companies that sell their shares on the stock market are broken into sectors. Sectors are groupings that pertain to the type of business the company engages in, and there are 11 sectors in total. These sectors include community services, consumer discretionary, staple staples, energy, financials, healthcare, industrials, information technology, materials, real estate, and utilities. During a recession, some sectors of the economy tend to outperform others as consumer needs shift. Delia Fernandez, a certified financial planner and owner of Fernandez Financial Advisory in Los Alamitos, California, says both the healthcare and consumer staple sectors are examples of this. In a 2021 study titled "Is Healthcare Employment Resilient and Recession-Proof?", healthcare hiring remains stable despite economic downturns. The healthcare sector includes biotech and pharmaceutical companies. The consumer staples sector includes food and beverages, household and personal products, and even alcohol and tobacco. These sectors typically don't see the rapid growth that others, such as the consumer discretionary, which are household goods and services that are considered more wants than needs, such as apparel, restaurants, and luxury items, and information technology might see in the rebound and recovery phase of a recession. In any downturn environment, we often look at consumer staples, and those are the usuals, the groceries we buy and the stores we buy them from, says Fernandez. Because no matter what, you're buying toilet paper. Eventually, you're going to go to the doctor. You've got to eat. You've got to drink. These stocks considered defensive stocks may not be as attractive during boom periods as in a bull market, but bear markets and recessions may be the time to reassess and consider companies that sell items everyone buys, no matter the outside circumstances, Fernandez noted. The most recent 2020 recession was the shortest on record. What can you invest in during a stock market crash? Treasury bonds. It's hard to find steadier investments than U.S. Treasury bonds, which are backed by the full faith and credit of the U.S. government. Investors padding their portfolios with low-risk investments that can provide a bit more yield than cash under a mattress have long turned to U.S. Treasury bonds. With terms of 20 and 30 years, Treasury bonds pay interest every 6 months until maturity, at which point the government pays you their face value. Rates constantly fluctuate, but recently Treasury bonds have yielded in a range between 1.375% and 2.375%. Corporate bond funds. If you're comfortable with slightly more risk than government bonds but still want the security of fixed income, corporate bonds may be just the ticket. Corporate bonds work a lot like Treasury bonds, except you're giving them to private companies. These private companies then turn around and use your investment to fund growth, though they have a slightly spottier but still generally good history of paying you back what you're owed. High-quality corporate bonds have historically provided steady, solid returns. For example, the SPDR Portfolio Corporate Bond ETF SPBO, which tracks the Bloomberg U.S. Corporate Bond Index, has a 3-year trailing return of about 8%, delivering positive returns even during the COVID-19 pandemic. Money market funds. Money market funds are ultra-low-risk mutual funds that invest in securities with short maturity periods, making them among the lowest-risk investments available outside of government bonds. That stability comes at a cost, though. Money market funds currently offer microscopic returns. Even the best money market funds average around 0.01% returns right now, so you probably won't want to allocate large percentages of your portfolio to them. Dividend stocks. Because of the regular income they offer, dividend stocks are beloved by the risk-averse and retirees. Companies like the dividend aristocrats have decades-long histories of managing the vicissitudes of the stock market with aplomb, all while paying out consistently higher dividends. While higher dividend payments mean you may not have to rely on your investment to increase as much in value to reach your goals, dividend stocks aren't without their risks. Unlike bond interest payments, dividend payments are not guaranteed, and during hard times, companies may reduce or remove dividends entirely. They're also still technically stocks, and their values may move with the overall market, meaning they may be just as likely to fall in value during a crash. To minimize the risk of that happening, you can opt for dividend funds instead of individual stocks. Gold and precious metal funds. Gold is the go-to choice of many investors coping with market volatility. Gold's value typically increases when the overall market struggles. Between 2008 and 2011, for example, gold's price rose more than 100% as the economy struggled through the Great Recession and moved into recovery. Over the last year, gold's price has risen just about 9,000%. Not a bad return until you compare it to the Dow Jones Industrial Average's DJIA, more than 60,000% gain. If you decide to invest in physical gold, you'll also need to pay for storage and insurance. Like physical gold, precious metal funds aren't necessarily the best bet for large quantities of your money. Though they can provide some stability during times of turmoil, they also may trail the market during bull markets. The 5-year trailing return of the iShares Gold Trust Fund was 6.5%, while the trailing return for SPY was 17.51%. What is the best way to avoid losing money? Avoiding losing money is just as crucial as making money when it comes to the prospect of getting rich. In the event of a market crash, it can be extremely tempting to look for the quick swing, buying highly volatile stocks on the fallout. Overall, it's far wiser to find great long-term investments at discounts to what they were asking. These instances provide opportunities to create excellent gains without taking on the risk of more speculative stocks. Look at the market crash of early 2020. Purchasing Bank of America back in April 2020 would have given you a nice 40% gain over the next 10 months. In a relatively similar period, General Motors produced gains of over 50% without the risk of something like Fisker and Lordstown Motors. The beauty of a market crash or correction is it creates deals on quality stocks. Bonus fact. Thank you for staying with us this far, lovely viewers. Here's a bonus fact as a token of our appreciation. A study by Ned Davis Research Group looked at 28 global crises over the past 100 years, from the German invasion of France in World War II to terrorist attacks such as that on 9/11. Each time markets overreacted and fell too far only to recover shortly thereafter. Those investors who sold on the fear found themselves having to buy back their portfolios at higher prices. while patient investors will be rewarded. Question: what do you think is the best way to make money during a crisis? Comment down below to let us know your thoughts. If you enjoyed the content, uplift the channel by hitting like, subscribe, and ring the YouTube bell to meet us again in the next video. Until next time.